You know, sometimes the most important lessons in life don't come crashing through the door with fireworks or thunder. Sometimes they arrive in a whisper, disguised as ordinary moments that eventually shape everything you become. And if there's one person who's quiet, wisdom has saved more people from financial destruction than any loud financial guru ever has. It's Benjamin Graham, the man who taught the world how to think about money before even touching it. Today, I want to take you on a journey through the mindset of Graham. Not just the theories, not just the formulas, not just the calculations, but the human truth underneath them. Because investing isn't really about numbers. It's about behavior, discipline, courage, and clarity. And if you can understand the person behind the decisions, you can master the decisions themselves. Benjamin Graham didn't start life with wealth. He wasn't born into privilege. In fact, his story begins with loss. Real, painful loss. His family was comfortable when he was young, but when his father died and the economy collapsed around them, everything changed. His childhood home suddenly felt colder, smaller, and unfamiliar. He watched his mother struggle, stretching every dollar, selling belongings to pay for necessities. Those memories carved lessons into him that no economics professor could ever teach. He learned what money really meant: security, survival, dignity, a shield against uncertainty. And that feeling stayed with him for life. That's the part most people never hear about when they study Graham. They learn about margin of safety, intrinsic value, rational analysis, but they don't learn about the boy who watched everything disappear and decided he would spend his life helping others avoid that same fate. And that is exactly why he created the framework that still guides the smartest investors today. But before we get into his rules, there's something you need to understand. Something people in the US, UK, and Canada feel deeply right now. The world isn't steady. Jobs change fast. Prices rise faster. News cycles create fear. Economies shift like storms over the ocean. And for most people, the overwhelming instinct is to react, to rush, to panic, to follow what everyone else is doing. But Graham believed reacting is the enemy. Preparation is the hero. Understanding is the shield. Patience is the weapon. And discipline is the victory. Let's start with the hook of his entire philosophy. The market is not your master. The market is your servant. You control your outcomes. The market doesn't. That's the foundation of real wealth. Eliminating emotional control from external forces. Now, let me take you into a personal story, a fictional illustration, but one built on the spirit of Benjamin Graham's teachings. Imagine a young American father named Daniel living in Ohio. He's in his mid-30s, 2 kids renting a small place, working long hours at a manufacturing plant. He's tired, stressed, and anxious, because every day feels like walking across a thin bridge while the wind pushes harder. He's always wanted financial stability, but every time he tries to invest, he gets scared. He saw his own father lose money during the 2008 crash. He saw neighbors panic during the pandemic recession. So Daniel stays out of the market, keeps money in a checking account. No investments, no long-term plan, just fear disguised as caution. One night after a long shift, he scrolls through the internet, looking for something, anything that might finally make sense. And he finds an old reference to Benjamin Graham. He reads a little, then reads more, then falls into the world of value investing. And for the first time, Daniel feels something rare: calm. Because Graham doesn't tell him to be fearless or brilliant or perfect. Graham simply tells him to be prepared, to be patient, to be rational, and that hits him deeply. Because Daniel is none of the flashy things modern finance influencers talk about, but he can be patient, he can be rational, he can learn, and that becomes his turning point. Graham's first cornerstone principle is something Daniel finally understands. Invest only when you understand the value, not the noise, not the hype, the value. Graham believed every asset has a real worth, an intrinsic value that exists independent of the market's mood. It could be a stock, a bond, a property, or even a business. If you don't know what it's worth, you have no business buying it. That's like walking into a store, closing your eyes, grabbing anything off the shelf, and hoping you got a bargain. That's not investing. That's gambling. Graham made investors understand that wealth doesn't come from taking wild risks. It comes from careful thinking, honest assessment, and intelligent choices. It comes from buying something when it's priced below what it's truly worth, and then holding it like you were holding a piece of the future. Now I want to take you into a different emotional moment. Imagine a young woman named Emily in Canada, working 2 jobs while studying. She wants financial freedom someday, but her world feels heavy. She sees others around her investing in trendy stocks and cryptocurrencies. She sees people bragging on social media about their profits, and she feels left behind. One day she reads Graham's most famous principle, margin of safety, and something inside her shifts. Graham said the margin of safety is the difference between what you pay and what something is really worth. It's not just a financial idea, it's a life idea. If your budget is tight, you keep savings for emergencies. That's margin of safety. If you're building a bridge, you make it strong enough to hold far more weight than you expect. That's margin of safety. If you're investing, you buy at a price where even if things go slightly wrong, you're still protected. That's margin of safety. Emily realizes her entire life has been built without safety margins. She has no savings, no investments, no cushion. Everything depends on everything else going perfectly, and life rarely works that way. Graham's message hits her like a reality check. A financially stable life is not built on hope. It's built on buffers. So she starts saving little by little. She starts learning about stable companies, strong balance sheets, good earnings, predictable cash flows. She starts investing slowly, patiently, consistently. Her life doesn't change overnight, but it becomes grounded, secure, steady. And that steadiness becomes her strength. Another lesson Graham taught was about temperament. He believed most investors fail not because they lack intelligence, but because they lack emotional control. Let me give you an example that reflects this. Imagine a man named Robert in London. Smart, successful, always trying to stay ahead of the curve. But every time the market dips, he panics. He sells the moment fear rises. And every time the market soars, he buys impulsively because he doesn't want to miss out. Graham would say, Robert's intelligence is irrelevant because his emotions dominate his decisions. And Graham believed that investing is not a test of brilliance. It's a test of resilience. The greatest returns go to those who can stay calm when others lose their balance, who can hold steady when the crowd runs wild. And that brings us to one of the most dramatic twists in Graham's life philosophy, something that surprises people. He didn't believe markets were efficient. He believed people were inefficient. People panic too quickly. They celebrate too quickly. They trust rumors too easily. They chase trends too blindly. They ignore fundamentals too often, and that emotional instability creates opportunities. Graham once wrote that the market swings between extreme optimism and extreme pessimism, rarely staying in the middle. That means the best chances to build wealth happen when panic creates irrational pricing, when good businesses trade for less than their worth, when fear clouds judgment. These moments don't come often, but when they do, your preparation determines your destiny. Let me give you a story-based illustration built on Graham's heartbeat. Picture a quiet street in New Jersey during the 1970s. A middle-aged man named Frank sits at his dining table with financial papers spread around him. His wife is asleep. The house is silent. The lamp is warm. He's reading Graham's work because he's trying to find a way out of the suffocating pressure he feels. Inflation is eating his income. Job insecurity is rising. Bills keep growing. He feels stuck. But as he reads Graham's words about discipline, margin of safety, intrinsic value, and long-term thinking, something inside him becomes steady. He realizes the world around him might be chaotic, but if he understands the value of what he owns and keeps a buffer between himself and risk, he can weather any storm. And for Frank, that realization becomes the anchor that carries him through years of financial turbulence. Now let's talk about one of Graham's most profound lessons, one that strikes at the heart of Western living. Live below your means, always. It sounds simple, but most people don't practice it. Modern life encourages upgrading everything: your house, your car, your vacations, your lifestyle. And as your income increases, your spending quietly rises with it. This lifestyle inflation destroys your ability to save, invest, or create buffers. Graham warned that wealth is not measured by what you earn. It's measured by what you keep. People earning $200,000 a year can be broke. People earning $40,000 can build real freedom. The difference is behavior, discipline, simplicity. Graham believed the more modest your lifestyle is, the more power you have. Not because you sacrifice comfort, but because you gain control. He believed financial freedom is not built on income, it's built on choices. And that brings me to a truth most people don't want to face. Wealth is quiet. Debt is loud. People show off new cars, new gadgets, new designer items. But those things often come with unseen costs: credit payments, interest, stress. Graham saw wealth as something internal, not external. Wealth is the ability to say no. Wealth is the ability to choose. Wealth is sleeping peacefully at night because you're not buried under obligations. Wealth is having the power to walk away from anything that compromises your well-being. Now here's a twist many people don't expect from Graham's philosophy. He didn't tell people to chase high returns. He told them to protect themselves from loss. Because avoiding major losses is far more important than chasing big wins. A 50% loss requires a 100% gain to recover. That's why Graham taught defensive investing, choosing reliable, stable assets with predictable earnings and strong foundations. But he also taught the importance of the enterprising investor, the one who is willing to analyze deeply, study carefully, and capitalize on opportunities when the market misjudges value. He offered two paths because he knew not everyone has the same temperament or dedication. But he made one thing clear: whichever path you choose it with discipline. Now let me take you into another emotional moment. Imagine a man named Michael from Toronto who loses his job during an economic downturn. He panics at first, but remembers the teachings of Benjamin Graham. He has cash reserves, investments in stable companies, and a lifestyle that doesn't drain his savings. He feels fear, yes, but not destruction. His preparation protects him. And when he gets a new job months later, he looks back and realizes that financial stability isn't about predicting the future. It's about preparing for what the future might bring. Graham taught that the market is a long game, a very long game. He believed real investing happens over decades, not days. And that's something modern culture often forgets. People want fast results, quick gains, shortcuts. But Graham believed wealth grows like a tree, slowly, steadily, quietly. And if you water it consistently, protect it from storms, and avoid cutting its roots, it will eventually become something powerful. And now we reach the heart of Graham's philosophy, the part that ties everything together. The market rewards discipline, not excitement. The market rewards patience, not speed. The market rewards clarity, not confusion. He taught that the intelligent investor is not the one who outsmarts the market. It's the one who outlasts the market. The one who builds a solid foundation, maintains a margin of safety, understands intrinsic value, controls their emotions, saves consistently, lives below their means, and refuses to let panic dictate decisions. That's the investor who survives every recession, every crash, every storm. That's the investor who thrives when others collapse. And now I want to leave you with the powerful ending. You deserve a final moment inspired by the spirit of Benjamin Graham. Imagine Graham sitting across from you, calm, steady, wise. He looks at you with the kind of quiet confidence that only comes from a lifetime of experience and says, "You don't need to predict the future to build wealth. You just need to protect yourself from the worst parts of the future and participate in the best parts of it." And then he adds something he believed with his entire being. The greatest investment you will ever make is not in a stock. It's in your own behavior. If you can master your emotions, understand value, maintain your margin of safety, and stay disciplined when the world becomes chaotic, then you are already miles ahead of most investors. Wealth will follow, security will follow, freedom will follow, and your life will change not because you chased money, but because you respected it. That's the legacy of Benjamin Graham. And if you take these lessons to heart, your future will look very different from your past. Not louder, just wiser, stronger, and far more secure.